Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today's special guest is Adrian Day, an asset manager based in Baltimore. Adrian, welcome to our show.
Well, thank you very much. Good to be here.
All right. So first off, just a little background. This year, Adrian Day actually is a manager of the #1 performing gold fund, so this will be a special treat. And we'll start off with the first topic. Gold. What does the gold market look like to you in a basic risk-reward scenario right now?
Well, fundamentally, longer term, 1 year, 2 years, I am extremely bullish, and we can go over the reasons for that. I think sometimes people can be a little bit too optimistic, shall we say, when markets turn. I mean, when you've had a market that's gone down 37%, and I think even more importantly, it's taken 2.5 years to do that. It's been pretty much steadily down, apart from a couple of rallies for 2.5 years. Markets don't just rebound to new highs in a couple of months. So I think we have to have realistic expectations, but from the bullish side. So there are times to buy, there are times to just stand on the sidelines and wait, but we're certainly not, we're certainly bullish on a fundamental basis. I think, in the very short term, the market, the rally from the middle of December had kind of exhausted itself, I think, had exhausted itself end of February, beginning, which is often typical, but then, we had the Ukraine situation that gave it an extra boost. Well, geopolitical situations, geopolitical spurts tend to be short-lived, so I would sort of hold back right now. But fundamentally very bullish for the longer term, yeah.
All right, and just out of the fundamentals, generally people, I see two fundamental factors right now. I would say demand and the money printing. Just if you had to guess, which one do you think is going to start being priced in more rapidly over the next 2 to 3 years?
Well, I think they both are, to be honest. And I hate to sort of not answer your question. I think I always look at, well, why did a market do what it did, and then has anything changed? So if you look at last year, why was the market so weak last year? And I think, number one, you had huge withdrawals. Nearly 900 tons of gold came out of gold ETFs. That's a massive amount. It takes the ETF holdings back to 2007. So that's the number one reason. That was a huge additional supply that was put on the market. And now it was offset by Chinese buying, but nonetheless, it was a huge amount of extra supply. So I asked myself, well, is that likely to continue? Has it changed? If you look at the numbers for the last several weeks, they're weekly numbers, so you go back to the middle of December, and you see that it definitely seems to be turning, and you're now seeing many weeks, not every week, but many weeks, where you're actually seeing inflows into the ETFs. So if you look ahead for the next year, I would say that what's likely is to get some inflows into the ETFs, and on an accelerating basis. It'll start slowly but build up. But at the very, very, very minimum, I would say that we're not, almost certainly, it's inconceivable that we're going to get the same amount of withdrawals that we had last year. So at the minimum, that one factor is now off the market. And the second factor in demand, so that was supply. The second major factor was the decline in Indian buying because of restrictions that the government put on gold imports. Now, in fact, gold imports into India were actually, the decline in imports was less than many people were expecting, given the restrictions, and also, frankly, given the weakness in the rupee, which made gold for Indians the second half of last year at virtual all-time high prices in rupee terms. So that obviously depresses the demand. So looking ahead, are we likely to see additional declines in India? I would say no. They're not going to put on more restrictions on gold. They've pretty much got all the restrictions you can put on, and yet the demand remained relatively strong. So again, looking ahead next year, that's likely, in my view, to turn around because the current account deficit is improving, the rupee is strengthening, so it's likely to turn around. India could vie with China for the number one position again. So on a supply-demand basis, I'm very, very bullish about gold. I don't know, the one big risk to me, I don't see monetary policy as a risk. I simply don't see significant monetary tightening in the U.S. or Europe or Japan anytime soon. I don't see, interest rates, if they go up at all, are likely to lag any increase in inflation. So real interest rates will remain exceedingly low or even negative, and that's bullish for gold. But one big risk I see, frankly, is China. If you saw a recession in China, then recessions typically reduce gold buying because people have less buying power. So that would be the one big risk factor that I would keep my eyes on.
All right. And it's interesting you brought up monetary policy tightening. I have a question. Do you think the Fed will actually be able to successfully unwind this stimulus in any manner?
Not in the near term. No, absolutely not. I mean, at the moment, they're reducing, as you know, the bond buying $10 billion a month. They've done it 2 months running. And we shouldn't forget that this bond buying is like an additional stimulus on top of already easy money growth and ultra-low interest rates. So all we're doing is sort of reducing that extra QE, QE5 or whatever we want to call it. I suspect that's priced into gold. I think one of the reasons that gold was so weak for the second half of last year was the uncertainty about the reduction in bond buying, the so-called tapering. Markets hate uncertainty. It's no coincidence that once the Fed actually announced they were going to cut back bond buying by $10 billion a month, it's no coincidence that coincided with the low in gold and low started going up. Markets hate uncertainty. $10 billion a month is, I won't say meaningless, but in the overall context of what the Fed is doing, it is very close to meaningless. And, we're now at $65 billion in new bond buying. That is still a massive amount of money coming in. I think the risk for the Fed is that something happens in the numbers, employment numbers, which they look at, inflation numbers, which they look at carefully. Those two they look at very carefully. Something happens that causes the Fed just to say, well, look, this month, let's skip this month, or this month, let's only cut by 5. Any deviation from that $10 billion a month reduction is going to be very bullish for gold, in my view, and it's an almost certainty. I mean, the Fed is really painted themselves into a corner, and they really can't get out of it, in my view.
Yeah, I definitely see that, in my opinion.
And may I just say one thing about interest rates? Interest rates, in my view, the Fed is also going to do everything in its power to keep interest rates low, particularly at the short end. Can't do much about the long end, but it can certainly do a lot of, it can do something about the long end by selling bonds and so on and trying to, increase the, it can try to manipulate the market. But in the short end, the Fed controls interest rates in the short end, and they're going to do everything in their power to keep interest rates low. That's not because of concern about the unemployed, although I'm sure they care about that. It's certainly not about the housing market, although they care about that. It's because of the interest burden on the federal government debt. Right now, the federal government is paying about 12 to 13% of revenues go to service its debt. That's high. It's been higher in the past. But that's 13% at a time when interest rates are at 70-year lows, and when the Federal Reserve, when the federal government is issuing more and more bonds at the short end, where rates are lower, rather than long-term bonds. You look at the average interest rate on all outstanding federal government debt, including 30-year bonds issued 28 years ago or whatever. The average is now about just over 2%, 2.1%. That's barely a 1/3 of the average that the federal government pays. Now, my point is, debt is so high right now that if interest rates started to move up towards that average, then you would start seeing the debt burden. If it moved halfway up towards that average, the federal government would be paying out over 20% of revenue on the interest burden, servicing the debt. And that becomes unsustainable at that point. So I think the Fed is going to do everything in its power to keep rates low.
Yeah. And one other thing you're also interested in besides gold is non-gold royalties. Can you tell us what they are or what type of royalties?
Well, we haven't even talked about gold royalties. I'm very keen on royalties in the resource space. The basic issue is that mining is an extremely difficult business. It's inherently difficult because of geology, because of things going wrong, rock slides, water flooding, shafts. It's just inherently difficult. And then on top of that, you have governments and environmentalists and all the additional man-made hurdles and burdens. So the royalty business is a great way to expose yourself to the sector, get most of the upside, but really minimize the downside. And I love the royalty business for that reason. In the gold space, the big ones like Franco-Nevada, Royal Gold, in my view, just great companies. And there's some smaller ones in that space as well. Then if you look at the non-gold royalties, there's a company called Callinan, which is a little, small. It's about 100 million market cap, so it's small. It's a royalty company based in Newfoundland, and they have they have a royalty interest on two producing mines. It's one royalty on two producing mines that generate revenue for them and enable them to pay a dividend. Right now, the dividend yield is about 3.9%. But they're also putting money into exploration companies and in return getting royalties. So this will pay off, hopefully, in the coming 4, 5, 6 years. Some of those exploration companies that they put money into will see mines come into production. Callinan gets a royalty. So I like that one a lot. Another one I love, a much bigger company, is called Altius. Altius started as an exploration company. It's 400 million market cap. They started as an exploration company. And what they did, anytime they got a partner in to one of their exploration projects, they would keep a royalty on the deposit, on the project, on the property, so that if it came into production at a later stage, they would get the royalty. So right now, they only have one producing royalty, which is on the Voisey's Bay nickel deposit. It's a small one. Basically covers all of their overhead, which is a nice position to be in. But they just recently acquired a package of royalties on coal and phosphate, coal and potash, in Western Canada, and that will start to generate significant revenue for them, once it closes, second half of the year. Altius, I suspect, I don't know this, but I suspect that, once they've paid off the debt that they took on to make that acquisition, they will start paying it out in a dividend. So yeah, there's a couple of very good companies out there in the non-gold royalty space.
Yeah. What other type of gold royalties do you like besides the Francos or the, Silver Wheaton?
Yeah, well, I mean, I would have to say, before answering the question, Franco would be my favorite company in the gold space for most investors. Particularly investors who don't want to watch on a daily basis, don't want to trade. They just want something that gives them exposure to the sector. Franco-Nevada right now has producing royalties on over 40 different properties, so you're getting a lot of diversification in that portfolio. And they have over 300 non-producing royalties, which over time, hopefully, some of them will become producing. So it's a very, you're getting a lot of diversification there, spreading the risk a lot. There's a couple of smaller ones. You mentioned Silver Wheaton in the silver space. No question, that's my favorite. It's actually a streaming company, not a royalty company. There are some differences between the two that perhaps we don't need to get into. From the point of view of most investors, they act in a very similar manner. And again, it mitigates the risk that investors face in this sector. There's a small royalty company. I'm trying not to miss out on any. There's a small royalty company called Gold Royalties, which is based in Alberta, and that's just a 10 million market cap, so you need to be kind of careful buying it. But that's a small royalty company that is going after smaller royalties, and it's also got an interesting concept of aggregating royalties. So if it sees a royalty, it will that it can't afford itself, but a royalty that it likes, it will bring in other royalty companies to get a piece of that pie. Very interesting concept, because you see that model with a lot of companies, private equity, business development companies. You see that sort of aggregating model in a lot. You haven't seen it in the royalty space. So I think that's a good idea there. Yeah.
All right. And also, you don't do most of your interviews are about gold, but you actually do more than gold, and you actually see great growth areas, Asia in particular. What are you seeing in Asia, and what countries?
Yeah. Well, if I always try to distinguish between economies and markets, because sometimes the strongest economies, the market's already discounted the economy. So overall, generally, we're kind of cautious we're kind of cautious on the global economies right now, but we're particularly cautious. I mean, I think the U.S., as everybody knows, most people seem to think, the economic recovery that we've had since 2008 has really been just extremely mediocre. And at this period of time after the bottom of a recession, we should be seeing much stronger employment growth and so on. So the U.S. is still growing, but it's kind of mediocre. Europe, I don't think the debt situation in Europe has been solved by any means. I think we're going to get another round of debt crises, because every single country in Europe, every major country in Europe other than Germany, will see their debt to GDP ratios go up next year. And yet the stock markets in Europe have generally, recovered to suggest that, that would lead you to think that that's over. So I think that's a risk that's not priced in. Asia, on the other hand, most of the emerging markets, Asia ex-Japan, most of the Asian markets, have come off quite a lot recently. There's been a slowdown in the growth in many of the markets in Asia, including China, of course, where growth has come down to about 7.25%, still pretty nice. But I think the stock markets, contrary to, say, Europe, the stock markets have actually fully discounted that decline. And if you look at most of the Asian economies, and of course they're all different, but you look at most of the Asian countries, they are in a much stronger fundamental financial situation than is Europe or the United States. Most of the countries there most of the governments, I should say, are carrying surpluses. Most of them have current account surpluses. Most of the banks are much stronger capitalized than Western banks, and most of the currencies are very undervalued. So fundamentally, the economies there are in a much stronger position, and I should also mention that the private savings rates are also much, much stronger in most Asian countries than they are in the West. So fundamentally much stronger, and yet the stock markets have come off over the last year or so reasonably significantly. One of my favorite markets is Singapore, and I like Singapore because it has some very, very strong companies. The market is down last year, down, 10%, not a lot. That's approximately. And yet you have some very, very strong companies there with nice dividends. So I like that market. Hong Kong, I think, has fully discounted potential problems in Hong Kong. So where we're looking right now is much more in the Asian markets, particularly the larger ones like Singapore and Hong Kong, less so in Europe and the United States.
And you also do high yielding and blue chip, correct?
Yeah. Well, I like dividends, even for relatively aggressive investors or younger investors who don't need the money now. I like dividends because a company that can pay consistent dividends and growing dividends, that's a sign of strength of the company. They say that earnings can lie, but dividends don't lie. So if a company can pay good dividends and increase those dividends, that's probably an indication that the company is doing well. Probably. You want to make sure they're not borrowing money just to pay the dividend, which companies do from time to time, which I think is kind of stupid. So I like dividends. Now, for people who are actually looking for income, one of my favorite sectors is the business development companies. In this country, business development companies are structured like real estate trusts, so they pay out all of their net operating income as dividends to investors. When they do that, they don't pay any tax at the corporate level, right? Investors pay the tax. So the dividends tend to be high, just as they are with real estate trusts. And what business development companies do is they lend money to typically small, mid-sized companies that need money. All business development companies are different. Some are more aggressive, some are less aggressive. But typically, they're lending money to companies for expansion, for management buyouts, to reduce debt, or whatever. Typically, business development companies don't invest in startups or turnarounds or high-risk situations. And these companies have typically paid yields anywhere from 7.5 to 10 or even more. There's one right now is a good time to buy these stocks because the S&P just decided to remove business development companies from all of their indices. And so there was a sell-off from managers that just follow the index, whatever the index is, they just follow it. Russell has also indicated that they may take all of the BDCs out of their index. So there's been a sell-off in the sector. Company like Ares, for example, Ares Capital, which is one of the larger ones, it's gone from 1850 to 1780 in the last month. That gives that stock a yield of 8.5%. This is a $5.5 billion market cap, so it's a big company. It's one of the more conservative. That dividend of 8.5% is well covered by net operating income, so it's not borrowing to pay the dividend. In fact, Ares is a company that actually has an accumulated net operating income that it can use. I don't want to get too technical on it, but certain types of income can be carried forward from one year to the next, and Ares actually has a carry forward but will allow it to meet that dividend even if the income went down this year. So, that's one I like. And then, at the more aggressive end of the spectrum, there's one called Prospect. Prospect was also in the S&P indices. It's a little more aggressive, I have to say. But that stock sold off from 1140 to 1080 in the last couple of weeks or last 10 days after S&P made the announcement. That's a pretty big sell-off. Prospect right now is yielding 12.3%. 12.3%. And it's covered by income. It's a $3.5 billion company, so again, not a tiny one. I caution people that Prospect is a little more aggressive, so the risk of them having to cut the dividend is higher than for Ares or some of the others. I'm not saying I think they will cut the dividend, and we're buying Prospect. We've been buying it very heavily since it sold off on the S&P announcement. But for people who want income, I think to buy a basket of 4 or 5 of these with yields between 8 and, well, in this case 12, is a very good thing for people who want income.
All right. That's actually interesting. I haven't heard of that sector, so I learned something. Well, I learned a lot today. So, if people wanted to find out more about you or wanted to purchase your gold fund, how can they do so?
Well, if they want to find out about us, the best place to go is just to our website, which is www.adrianday.com. Make it easy, ADRIANDAY.com, and that talks about our money management. The fund, as I mentioned, it's as you mentioned, it's Peter Schiff's Europe Pacific Capital that sponsors the fund, and we are the sub-advisor. They hired us to be the sub-advisor. You can go to their website. Unless if you're a client of Europe Pacific, just call your broker. But if you're not a client of Europe Pacific, you can just go